In the realm of finance, knowledge is power, and the S&P 500's rally is a goldmine of wisdom. Did you know that in just 3 months, it soared to heights that left even seasoned traders slack-jawed? We're talking a 10.6% total return in the first quarter of 2024, following a robust rally in the final quarter of 2023 that took its cumulative gains to 22.3%. Hey there, savvy investors and market enthusiasts. Welcome back to Fun Financial Insights, where we turn the complex world of finance into a thrilling roller coaster of learning and laughs. Today, we're diving into a historical marvel, the greatest financial event in a century, the S&P 500's 3-month rally of 2024. And keep watching, because we're about to take a wild ride through the numbers that have Wall Street buzzing. Before we zoom into the rally itself, let's set the stage. The S&P 500, a stock market index that measures the stock performance of 500 large companies listed on stock exchanges in the United States, is often seen as a barometer for the overall health of the U.S. economy. When it rallies, it's not just numbers going up, it's a signal of confidence, a beacon of optimism, and sometimes a prelude to an economic boom. Over the past 3 months, the S&P 500 was not just rallied, it sprinted like a cheetah in the savannah. We're talking about a robust 15.54% increase in value. That's not just impressive, it's practically unheard of in such a short span of time. But wait, there's more. This rally wasn't just a fluke or a flash in the pan. It's been fueled by a confluence of factors that have investors grinning from ear to ear. For starters, we've seen a surge in corporate buybacks, with companies scooping up their own stocks like they're going out of style. Goldman Sachs is modeling a whopping $925 billion in repurchases this year. And let's not forget the massive inflow of cash into money market funds, to the tune of $1.6 trillion since last year. That's a lot of dry powder waiting to be deployed, and it's just one of the reasons why this rally has legs. The market has also been buoyed by positive economic data. We've seen the S&P 500 post a total return of 3.2% in March alone, and is now ahead 10.6% year to year in 2024. With concerns over a U.S. economic recession subsiding, investors are shifting their focus to the timing of the Federal Reserve pivot from monetary policy tightening to policy easing. And let's not overlook the record-setting targets strategists have revamped their S&P 500 targets for the end of 2024, with the median target now sitting at a cool 5,200 points. That's less than 1% decline from current levels, signaling that the confidence in the market's trajectory is strong. But what exactly is a rally? In financial lingo, a rally refers to sustained upward movement in stock prices. It's like the stock market decided to do its own impression of a rocket ship, up, up, and away. But rallies aren't just about numbers. They're about the mood, the zeitgeist, the collective optimism of investors. Fellow investors, it's time to put on our analytical hats and dive into the why behind the rally. Past rallies have been sparked by a myriad of factors. But what's fueling the S&P 500 surge in 2024? Let's look at the data. Historically, rallies have been ignited by economic recoveries, technological innovations, and favorable monetary policies. For instance, the post-World War II boom was driven by industrial expansion and consumer spending. The dot-com bubble was inflated by the internet revolution. But today's rally? It's a different beast altogether. In 2024, we're witnessing a rally that's riding on the back of several key factors. First up, artificial intelligence. AI-related stocks have been on fire, with companies like NVIDIA seeing their shares soar by 82% year to date, pushing its market caps to a staggering $2.29 trillion. But it's not just AI. The broader market has seen a total return of 3.2% in March, contributing to a 10.6% gain year to date. This rally is underpinned by positive economic data and a subsiding fear of a U.S. recession. Instead, eyes are on the Federal Reserve, which is expected to pivot from tightening to easing monetary policy. And speaking of the Fed, let's talk interest rates. The federal funds rate is projected to fall to 5.1% by the end of 2024, with cuts likely later in the year as inflation cools. This anticipated easing could further fuel the rally, giving the investors another reason to be bullish. Although there are a lot of reasons to be bullish, some indicators say the contrary. One of these is the Buffett indicator. So what's the big deal with the Buffett indicator? It's like the market's temperature gauge, a financial barometer named after the legendary investor Warren Buffett. This indicator compares the total market value of publicly traded stocks to the gross domestic product, providing a high-level view of market valuation. When the ratio is high, the market might be running a fever, possibly overvalued. When it's low, the market could be feeling chilly, potentially undervalued. As of February 29, 2024, the total U.S. stock market value stands at a colossal $54.15 trillion, while the annualized GDP is $28.04 trillion. This puts the Buffett indicator at 193%. Historically, this ratio has fluctuated, but the current figure is about 57.84% above the historical trend line, suggesting the market is overvalued. With the Buffett indicator standing at a whopping 193%, what does that mean? Let's break it down. When the Buffett indicator exceeds 100%, it's like the stock market has had one too many espressos. It's jittery, excited, and possibly overvalued. Our current reading of 193%, well, that's like the stock market doing cartwheels on a tightrope. When the stock market grows much faster than the actual economy, it could signal a bubble. To put this in perspective, the historical average for the Buffett indicator in the U.S. is around 79%. We're significantly above that. Warren Buffett himself has hinted that when the ratio is sky high, it might signal overvaluation. And when the ratio is below 100%, it's like the market's whispering, hey, stocks are on sale. But remember, the Buffett indicator isn't a crystal ball. It's more like a weather vane. It doesn't predict exact storms, but it hints at market conditions. So, while it's flashing overvalued, it doesn't guarantee a market downturn. Keep your umbrellas handy, but don't cancel the picnic just yet. Now, before we march on, let's take a moment. If you're finding value in our financial escapade, smash that like button. Now hold on to your portfolios because we're about to dive into the deep end. The next part of our episode tackles the counter arguments to the Buffett indicator, the role of the U.S. money supply, and the Federal Reserve's unexpected moves. Plus, we'll explore the AI revolution and its impact on the stock market. Let's talk money supply. You've heard the term quantitative tightening. But what does it mean for our rally? Quantitative tightening is the Federal Reserve's way of taking a step back from the market. It's like a bartender cutting off the free drinks. Eventually, the party calms down. But here's the twist. Even with QT, the U.S. money supply remains robust. As of February 2024, the M2 money supply, which indicates cash, checking deposits, and easily convertible near money, stands at $20.78 trillion. That's a slight decrease from January's $20.79 trillion. But here's the kicker. The money supply hasn't contracted like this since the Great Depression. Now you might be thinking, isn't less money in the system bad for stocks? Not necessarily. This contraction could be a sign of the economy normalizing after the pandemic's unprecedented stimulus measures. Plus, the Federal Reserve is projecting to halt QT in 2025, which could signal a return to more liquidity. Despite the Fed's tightening, the money supply is still ample compared to historical levels. This abundance of liquidity has cushioned the economy and corporate profits from the impact of rate hikes. Many U.S. households and companies have locked in low interest rates, making them less sensitive to monetary tightening. So what does this mean for our rally? It suggests that while the Fed is being cautious, there's still plenty of fuel in the tank. The money supply, combined with the Fed's future plans, could keep the rally going for the long haul. Another reason the rally might go on longer is monetary policy. In a surprising twist, the Fed has signaled plans to cut interest rates despite the absence of a recession. What's the deal? Here's the scoop. The Federal Reserve officials have hinted at 3 rate cuts in 2024. This comes after a period of inflation that's been stickier than expected, with the Consumer Price Index, CPI, still above the Fed's comfort zone. But why cut rates if inflation is still a concern? The Fed's playing the long game. They're betting on improvements in supply chains and labor availability to keep the economy humming along, even as inflation cools down. And what about the impact on the stock market? Historically, rate cuts have led to mixed reactions. On one hand, they lower borrowing costs, which can boost spending and investments. On the other, they can signal economic headwinds ahead. It's a double-edged sword. Now let's turn our gaze to the future. A future where AI is not just a buzzword, but a fundamental driver of economic growth. The growth of AI is not just reshaping industries, it's redefining the stock market itself. AI's impact on the stock market has been nothing short of revolutionary. Companies leading the AI charge, like NVIDIA, have seen their market cap skyrocket to over $1 trillion, with a year-to-date increase of more than 175%. This surge is not isolated. AI-affiliated mega-cap stocks across the board have been backstopping the market against various economic headwinds. The implications of the economy are staggering. AI could contribute a 21% net increase to the United States GDP by 2030. And as for the stock market, experts predict that the S&P 500 could rally to 5,200 points this year, implying at least a 9% gain for 2024. The following year could see stocks soar another 30%, assuming the Fed continues to cut interest rates. All right, fellow market navigators, let's wrap up our financial adventure with a compass in hand. How do you leverage this rally? Diversify your portfolio. Spread your bets like a seasoned poker player. Don't go all in on a single stock or sector. Diversification is your safety net. Monitor leading stocks. Keep an eye on those relative strength lines. Stocks outperforming the broader market could be your golden geese. Gradual commitment. Don't rush. Generally invest as the rally unfolds. Rome wasn't built in a day, and neither is a solid portfolio. Well, that concludes our financial journey through the highs and lows of the stock market rally. Whether you're a seasoned investor or a curious learner, remember that the market is a dynamic ecosystem. Adapt, learn, and stay agile. And as always, if you found this episode insightful, hit the like button and subscribe for more financial wisdom.